What we hear all the time, any merchant that we talk to, the biggest concern that they have in the market is credit declines. And that is continuing to increase across the board.
So we're living in an interesting macro environment as it relates to financing. Like I know interest rates are a component of that. Interest rates in 2022 went up a lot. And then starting in September of last year, they got cut a handful of times, but have not since. There's kind of this uncertainty looming, and the Fed has said, we don't know what we're going to do. Consumers seem like confidence is going down, but they're still relatively in good shape, but starting to cut back a little bit. Based on your conversations internally and how you guys are thinking about this, any comments you have on the macro environment?
Yeah, I think macro is something that everyone needs to think about holistically on what their strategies are going to 2025. We've seen the $9 billion in funding with the Inflation Reduction Act of 2022. They had that 90-day pause as the new administration came to be. However, recently that was turned back on, but 5 states have still basically cut funding there. So there's a lot that you have to do in the states that you operate in to navigate what those potential uncertainties are with rebates and how you sell a new unit. With all that uncertainty, I think what we've seen is people are gearing towards repairs a lot more often. A couple reasons for that. When the mortgage rates increase, it's the highest we've seen in the last 20 years to 6-7% across the board. That tends to correlate with less HVAC replacements. It's an interesting deal as you think people stay in the homes will replace more. However, that's not the case historically. So people still need to obviously have HVAC systems in their house, but they're opting towards repairs. And in 2024, due to some of the factors we discussed, repairs actually increased from a finance perspective 37%, which is a significant chunk. Installs reduced about 7%, still pretty in line because there was a huge uptick in 2023. So still big jumps there. But overall, the trend has been people are financing and looking for repairs a lot more. If an HVAC contractor is not offering financing on those $2,500 or $4,000 repairs, you're doing yourself a disservice as well as the borrower. There is still a decent amount of shopping around that happens. So you want to offer a financing solution that will be able to, number one, take that, and number two, provide offers that the customer wants to say yes on.
Have you noticed any trends as far as approvals or rejections or declinations on the consumer end that stand out at all?
Yeah, what we hear all the time, any merchant that we talk to across the board, the biggest concern that they have in the market is credit declines. And that is continuing to increase across the board. Declines, and that's with, the no-nos 12 months, 18 months, same as cash plans, the 10-year plans. Most lenders are just tightening their credit spectrum, who they will approve. You don't exactly know when that's going to happen due to macro concerns. We can get into Wisetack specifically and what we do, but overall declines are on the rise, and it's a big concern for contractors that we've talked to.
Yeah, I think you made a good point about the sort of waterfall approach and having a diversified mix of options. Are you seeing any trends as far as specific option plans that are becoming more popular or less popular? To your point, longer term, low interest plans versus same as cash versus zero interest, whatever it might be.
I think with the declines on the rise and the APR sensitivity on the borrower side, people look towards those 0% options. We think about it in 3 ways, right? There's 3 types of individuals that are going to be financing something. So it's going to be the 0% people that just never want to pay any interest and want to break that out and give them flexibility to pay it off in 6, 12, or 24 months or whatever that may be. The other big bucket that we see in the contractor space is, hey, they just want the lowest possible monthly payment, where it's like a 10, 12, 15 year, let's get the monthly payment as low as possible. Then we've also seen a trend toward intermediate type of loans, where it's a 3 or 5 year, maybe interest bearing, but it gives the customer that flexibility to not get locked into 10 years of debt, extreme amount of interest that they're paying. Because if you look at the overall cost of a new unit of $15K and you're doing a 1099 10-year loan, the overall cost is going to be around $22 to $25K, depending on kind of what APR you get. So it's very significant. And 10 years of debt is a long time. So what we're seeing, especially with the younger generation, is they don't want to be locked into something that long. Maybe 3 to 5 years makes sense for them. Their monthly payment will be a little bit higher, but it gives them that flexibility to not have to pay $15K out of pocket right now.
Yeah, that makes sense. I wonder, based on my conversations, at least, if you guys are hearing the same thing, but it seems there's an expectation at the contractor level for financing to be a greater percentage of revenue as it has in the past, just given the situation.
The stats we've seen and talk about internally is on new units installs. I think still to this day, 81% of those are paid by cash or credit card. 19% across the board is finance right now. That is going to continue to grow, I think, very significantly over the next couple years, 5 years, 10 years, as the borrower profile is changing. And as Gen Zers, Millennials start owning homes, the Gen Xers and baby boomers are used to using their savings accounts to pay via cash. A Gen Z or Millennial is twice as likely to take out financing because they're much more cash strapped in baby boomers or Gen Xers because they've been saving a longer time, been in the work world forever, and did a very good job at saving. There's a lot of other macro trends that can explain why Millennials and Gen Zers don't have as much cash on hand, but the nuts and bolts of it are the younger generation is used to paying in financing. They pay for new dresses, new things on e-commerce websites using BNPL. So it's just the trend. They're used to it. They're comfortable with it, and it provides that flexibility. So we'll continue to see trends upward. If you're not offering financing, you need to be. And if you're not offering financing on 20, 30% of installs, that's what we've seen successful merchants doing. If you're not doing repairs, that's a brand new segment, because now like $2,500, $3,000 costs that a lot of people don't want to necessarily take. And by providing a seamless financing option, you're going to win that business a lot. So it'll continue to increase, and we hear that across the board.
Yeah. Speaking to the tactics, to your point, is there something you guys are noticing that contractors are doing wrong as far as offering or executing financing, whether it's how they're presenting options or maybe even the mix of options they are presenting? I'm just curious if there's anything that you guys are talking to contractors about that you think is not ideal.
So I'll start with the repair side. A lot of times, if a customer wants financing for anything under $3,000, they don't want to work with them pretty frequently. However, I think what we see is there's heavy appetite for financing right within that range. When we see 1,500, 2,000, that's when it really starts to uptick. Even if I just do a 12-month plan, I'm paying about $100 a month. Gives people flexibility. This is an old stat, and everyone knows that credit card debt is way up. It's at like highest it's been in the last 12 years or so. Continues to increase. So debt is real and it's happening, and people are cash strapped. 56% of Americans don't have $1,000 for an emergency bill. So yes, like you may not want to necessarily work with them. However, these are people that want to say yes, they just can't because they don't have the cash on hand to make them comfortable over the next couple months. So I think you're doing yourself and the borrower a disservice from actively discouraging financing for something that's a couple $1,000 that you're not traditionally used to financing. And your demographic is changing. As Millennials and Gen Zers start moving into homes, they have a mortgage payment, they have a car payment, a lot of things that have fixed costs. You need to have something available to give them the ability to say yes comfortably and not feel cash strapped, and create that great experience to have that long-term relationship with them. Because the longer they live in the home, hey, you provide me options when I needed it, you'll continue to work with them for a long time. So that's number one. I think contractors need to be more comfortable in offering financing for those lower ticket items as well. Number two, I think it comes down to what people have been doing for the last 10, 15 years in offering financing. And that is like traditional rate sheet based plans, where a lot of things that we hear is contractors think that customers want two options. It's going to be the lowest possible monthly payment so that they're only selling to that, or a 12 or 18-month no kind of credit card type of plan. Whereas what we hear from the borrower demographics is the modern generation does not want to open up a credit card or potentially take on 10 years of debt that has a lot of ancillary fees associated with it. There's maybe a loan origination fee, a prepayment penalty, all these fine print things that they're not aware of, where they're locked in and don't really understand the financial product they're taking on. What we're seeing with the younger generation as well is they're used to transparent financing. It takes 60 seconds and get approved for a loan and then move forward. So bringing it all together, if you're specifically selling a specific plan, you're probably doing yourself a disservice as well as the borrower from actually choosing something that makes sense for them. There's a lot of potential. If you're selling rate sheet based plans, you have to do a lot of front end determination and diagnosing what their credit profile looks like, what they might want. But if you have 8 different plans, you're probably not going through 8 different applications to see which one makes the most sense for them. By having a single application that provides a bunch of different offers within one, that allows the customer to choose what makes sense for them. That's what we're seeing people shifting towards as we progress into 2025.
Speaking of that, kind of the rest of this year, what are you watching? What are you paying attention to macro wise that could potentially have a downstream effect on all this stuff that we're talking about? Is it just interest rates? Is it consumer debt? Is it savings levels? Just curious, any thoughts you have on how that might play out?
We're looking at all that, but I think one of the front-facing things we have to be aware of is how tariffs are going to affect contractor pricing on what they're buying. We've seen a lot of and hearing a lot from contractors that, hey, they're trying to bulk buy a lot of these things at the current pricing because they don't know when uncertainty happens. We need to lock in where we're at because this could exponentially increase over the next couple of months. So understanding what tariffs are going to do for the future state of the HVAC industry and what that's going to do to overall pricing. If it continues to increase, that inevitably will be pawned off onto the end borrower. If your average new unit install is $15K right now, if tariffs continue to increase, that may be $18 to $20K, which, what does that mean? People need more financing. It inevitably will end up on the borrower side. So if that continues to happen, those new units will continue to increase, which will inevitably need more financing. But also, if those costs continue to increase and it just prices people out of the market, then they'll probably offer repairs. So you need to be offering financing on the repair side too. So kind of all of that, tariffs are number one, obviously. So how are mortgage rates happening? What are overall interest rates? How is the administration going to handle the Inflation Reduction Act of 2022 so that customers can get those rebates to get that overall cost down? A lot of those things we're looking at all the time, and then hearing from contractors how they're adjusting their approach to combat some of these underlying uncertainties of what's happening.
Yeah. What else are you hearing that we haven't talked about so far, whether it's from manufacturers, contractors, distributors, your team internally, economists, whatever, that you think is worth talking about or paying attention to as it relates to all this?
Overall, from a macroeconomic perspective, I think we hit a lot of the points. One other thing that potentially to touch on is the A2L refrigeration transition. Obviously, that's affecting some things in the market. OEMs warned of potential 10 to 15% increases. So what does that mean? 10% price hikes on A2L units, which inevitably will be passed on to consumers. So everything that we basically talked about today is leading to higher prices across the board. That is inevitably passed on to the consumer. And the consumer is already cash strapped, right? So in the end, financing has to be a huge part of your 2025, 2026 game plan, offering it on every single job because you don't know what the consumer's situation is financially. You can still live in a $2 million house, but most people live paycheck to paycheck these days. So you need to offer financing options on anything that you're doing and have a good option that makes it easy for them to say yes. Basically, the macroeconomic trends are prices are continuing to increase, and you need to be aware of that and have suitable solutions so that customers continue to buy from you so that you continue to grow.
Yeah, I think the interesting thing is that's certainly the truth. I think we're in an inflationary cost environment across the board. Every industry, doesn't matter. On the wholesale side, the retail side, doesn't matter. And I think this might sound simple, but the wealthier pockets of the country are a little bit more insulated just because they can afford things regardless. They're not as concerned about paying an extra $100 a month or whatever over a certain period of time. Whereas I'd say maybe the lower to middle income areas, most of the people in the country, this is more relevant to. I think it'd be interesting to see. I don't know if there's a data point on it. Maybe you guys have it, but maybe 2025, once we get through this year, what is the rate of financing adoption on the consumer side by income bracket? That would be interesting to me. Will wealthier consumers still do it anyway? If they can get a 0% option, they can just shell out monthly payments, even though they can pay 20 grand up front. Like, why?
That's an interesting deal. And we hear a lot too about, hey, we don't need this. We work in well-to-do neighborhoods. There's a reason why individuals got where they are. There's a reason why people have 800 plus credit scores. It's because they understand how to leverage financing and manage money. So if you have a $20,000 one unit or 2 unit install system, if you have the ability to break that up in 12 monthly payments or 24, whatever it may be, people opt to do that a lot. Number one is, hey, do I have an investment opportunity that I want to do so I can keep some cash on hand and not dish this out if I don't need to? So just by looking at someone, you never understand what they want to do or how they are as a buyer. We see all the time, like, hey, we have a singular or double unit install going on, or even a repair. If I can break this down 12 months, 0%, I'm going to do it every day, because as I make on-time payments, my credit continues to increase. So then I can do more on the back end for the future. I can get a better mortgage rate on my next home, whatever it may be. These guys understand how to use this and leverage it in a good way. That's why you need to have suitable options for all types. You're going to have the super prime that get great rates and leverage them. But then also that middle income tier, that's the biggest portion of the market, will also want this, maybe not a 0%, but maybe 3 to 5 year plan or a 10-year plan if they just want to potentially break that up and get the lowest possible monthly payment and then pay it off when they get a bonus check or something like that.